Question 1. Stakeholder feedback indicates a growing demand from clients for comprehensive legal defense coverage, often expressed as a desire for full protection against any lawsuit. As an advanced insurance broker, how should you approach a client who makes such a broad request for legal defense insurance, considering the need for a robust risk assessment? Option A. Immediately source the broadest available legal defense policy that matches the client's stated desire for full protection, assuming their request accurately reflects their needs. Option B. Advise the client that comprehensive legal defense coverage is prohibitively expensive and suggest a minimal policy that covers only the most common types of litigation. Option C. Conduct a detailed risk assessment to identify specific potential legal exposures relevant to the client's industry and operations, then recommend a policy tailored to those identified risks, explaining the rationale and any limitations. Option D. Agree to the client's request for full protection and select a policy that appears to offer the widest scope of coverage without conducting any specific risk assessment, prioritizing client satisfaction. The correct answer is C. Conduct a detailed risk assessment to identify specific potential legal exposures relevant to the client's industry and operations, then recommend a policy tailored to those identified risks, explaining the rationale and any limitations. Explanation. This scenario is professionally challenging because it requires the broker to balance the client's immediate desire for a specific coverage with the insurer's underwriting requirements and the broker's duty to provide suitable advice. The broker must conduct a thorough risk assessment to ensure the proposed legal defense coverage is appropriate for the client's actual exposure, rather than simply accepting the client's stated preference without due diligence. The correct approach involves a comprehensive risk assessment that identifies potential legal exposures relevant to the client's business operations. This includes understanding the nature of their activities, contractual obligations, regulatory environment, and past claims history. Based on this assessment, the broker can then recommend legal defense coverage that is tailored to these specific risks, ensuring it is both adequate and compliant with regulatory expectations for suitability. This aligns with the principles of professional conduct and the duty of care owed to clients, which mandate that advice provided must be appropriate to the client's circumstances and needs. An incorrect approach would be to simply accept the client's request for a broad, unspecified legal defense policy without further investigation. This fails to meet the broker's obligation to assess risk and provide suitable advice, potentially leaving the client underinsured or paying for coverage they do not need. Such an action could be seen as a breach of regulatory requirements concerning client advice and product suitability. Another incorrect approach would be to recommend a policy that is demonstrably inadequate for the identified risks, perhaps due to cost-saving measures or a misunderstanding of the client's operations. This also constitutes a failure in the duty of care and could lead to regulatory sanctions for providing unsuitable advice. Finally, an approach that prioritizes securing the business over providing sound advice, by agreeing to a policy that the broker knows is unlikely to respond effectively to the client's actual legal exposures, is ethically and regulatorily unsound. This prioritizes commercial gain over client welfare and professional integrity. Professionals should employ a structured decision-making process that begins with understanding the client's business and potential risks. This involves active listening, asking probing questions, and utilizing available resources to gather information. The next step is to analyze these risks and determine the appropriate insurance solutions, considering coverage scope, limitations, and exclusions. Finally, the broker must clearly communicate the rationale behind their recommendations, ensuring the client understands the coverage provided and its relevance to their identified risks. This process ensures that advice is informed, suitable, and compliant with regulatory standards. Question 2. Compliance review shows a broker has recommended a unit-linked insurance plan to a client who has expressed a strong desire for high investment returns and has indicated a willingness to accept some risk. The broker has explained the potential for capital growth linked to investment performance and the insurance cover provided. However, the review notes that the broker did not conduct a detailed assessment of the client's overall financial situation or explicitly confirm the client's understanding of the charges, fees, and the possibility of capital loss. Which of the following represents the most appropriate best practice approach for the broker in this scenario? Option A. Focus on highlighting the insurance benefits of the plan, as this is a core component of the product, and assume the client understands the investment aspects given their stated desire for returns. Option B. Conduct a thorough suitability assessment, including a detailed review of the client's financial objectives, risk tolerance, and understanding of the unit-linked product's features, risks, charges, and the potential for capital loss before making a final recommendation. Option C. Provide a simplified explanation of the investment component, emphasizing the potential for high returns, and proceed with the sale, as the client has indicated they are comfortable with risk. Option D. Proceed with the sale as the client has expressed a desire for high returns and indicated risk tolerance, and the broker has outlined the potential for growth and insurance cover. The correct answer is D. Proceed with the sale as the client has expressed a desire for high returns and indicated risk tolerance, and the broker has outlined the potential for growth and insurance cover. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires the broker to balance the client's stated desire for a specific investment outcome with the regulatory obligation to ensure the product sold is suitable and that the client fully understands the risks involved, particularly with unit-linked products which combine insurance and investment elements. The broker must navigate the potential for misrepresentation or misunderstanding of the product's nature and performance, which can lead to significant client detriment and regulatory breaches. The inherent complexity of unit-linked plans, where investment performance directly impacts policy value and benefits, necessitates a high degree of diligence and clear communication. Correct approach analysis. The correct approach involves a thorough assessment of the client's financial objectives, risk tolerance, and understanding of unit-linked products. This includes explaining the nature of unit-linked plans, the relationship between investment performance and policy value, the associated charges, and the potential for both gains and losses. The broker must ensure the client comprehends that the capital is at risk and that past performance is not indicative of future results. This aligns with the regulatory duty to act in the client's best interests, to provide clear, fair, and not misleading information, and to ensure suitability of the product. Specifically, under the FCA's Conduct of Business Sourcebook COBS, particularly COBS 9 Suitability and COBS 10 Appropriateness for retail clients, brokers are mandated to gather sufficient information to make a recommendation and ensure the client understands the product's features and risks. Incorrect approaches analysis. Recommending the unit-linked plan solely based on the client's stated desire for high returns without a comprehensive suitability assessment is a regulatory failure. This approach neglects the broker's duty to ensure the product is appropriate for the client's circumstances and risk appetite, potentially leading to a sale that is not in the client's best interests. It also risks misrepresenting the product by focusing only on potential upside without adequately addressing the downside risk, which is a breach of COBS 4, communicating with clients, financial promotions, and product governance. Proceeding with the sale after a superficial explanation of the investment component, without confirming the client's understanding of the risks and charges, is also a failure. This bypasses the crucial step of ensuring the client is fully informed and capable of making an informed decision, contravening the principles of client understanding and transparency required by COBS. The broker has a responsibility to ensure the client grasps the implications of investing in a unit-linked product, not just that they are aware of its existence. Focusing only on the insurance benefits of the unit-linked plan, while downplaying or omitting the investment risks and performance dependency, is a significant ethical and regulatory breach. This misrepresents the product's dual nature and can lead the client to believe they are purchasing a guaranteed insurance product when, in fact, their capital is exposed to market fluctuations. This is a direct violation of the FCA's principles, particularly Principle 7, Communications with Clients, and Principle 3, Fitness and Propriety, as it involves misleading communication and a failure to act with due skill, care, and diligence. Professional reasoning. In situations involving complex financial products like unit-linked insurance plans, a professional broker must adopt a structured decision-making process. This begins with a comprehensive fact-finding exercise to understand the client's needs, objectives, financial situation, and risk tolerance. This information then forms the basis for product recommendation. The broker must then clearly explain the product's features, benefits, risks, charges, and how it aligns with the client's profile. Crucially, the broker must verify the client's understanding of these elements, particularly the investment risks associated with unit-linked plans. If there is any doubt about the client's comprehension, or if the product appears unsuitable, the broker must either provide further clarification, recommend an alternative product, or decline to proceed with the sale. This process ensures compliance with regulatory requirements and upholds the ethical duty to act in the client's best interests. Question 3. The performance metrics show that a long-standing client, Artisan Crafts Limited, has consistently requested a reduction in their annual public liability insurance premium. For the upcoming renewal, they have explicitly instructed their broker to lower the public liability indemnity limit by 50% to achieve a significant cost saving, stating they believe their current limit is overkill, and they have not had any claims in many years. The broker knows that Artisan Crafts Limited has recently expanded its operations to include online sales and has a growing social media presence, increasing its potential reach and exposure to product liability and reputational damage claims. Which of the following represents the most appropriate professional approach for the broker? Option A. Agree to reduce the public liability indemnity limit as requested, but add a note to the policy schedule stating that the reduction was made at the client's specific instruction, thereby absolving the broker of any future responsibility. Option B. Immediately implement the requested reduction in the public liability indemnity limit to meet the client's explicit instruction and achieve the desired premium saving, as the client is ultimately responsible for their insurance decisions. Option C. Suggest an alternative, lower-cost policy from a less reputable insurer that offers a reduced indemnity limit but still meets the client's stated premium reduction target, without extensively detailing the potential differences in coverage scope. Option D. Advise Artisan Crafts Limited that, while a premium reduction is possible by lowering the indemnity limit, this action would significantly increase their uninsured exposure and explain the potential consequences of underinsurance, recommending they maintain or even increase their current limit based on their expanded operations and increased risk profile. The correct answer is D. Advise Artisan Crafts Limited that, while a premium reduction is possible by lowering the indemnity limit, this action would significantly increase their uninsured exposure and explain the potential consequences of underinsurance, recommending they maintain or even increase their current limit based on their expanded operations and increased risk profile. Explanation: this scenario is professionally challenging because it requires the broker to balance the client's immediate desire for a cost-effective solution with the fundamental regulatory obligation to ensure adequate and appropriate cover. The client's focus on premium reduction, while understandable, could lead to a significant gap in their public liability protection, exposing them to substantial financial and reputational risk in the event of a claim. The broker must navigate this by providing expert advice that prioritizes regulatory compliance and client protection over short-term cost savings. The correct approach involves thoroughly assessing the client's business operations, identifying all potential public liability exposures, and then recommending a policy that provides appropriate limits and endorsements to cover these risks, even if it means a higher premium. This aligns with the regulatory framework's emphasis on acting in the client's best interests and ensuring they are not underinsured. Specifically, under the Advanced Insurance Broking Exams jurisdiction, assumed to be UK for this context, referencing FCA principles for businesses and relevant ICOB/PROD guidance, brokers have a duty to understand their clients' needs and circumstances, provide clear and fair information, and ensure that any product recommended is suitable. Recommending a policy with inadequate limits, even if cheaper, would breach the duty to act with integrity and skill, and potentially lead to a breach of suitability requirements under PROD. An incorrect approach would be to simply accept the client's instruction to reduce the premium by lowering the public liability limit without further investigation or explanation. This fails to uphold the broker's professional responsibility to advise on adequate cover. It could lead to the client being significantly underinsured, meaning that in the event of a large claim, the policy payout would be insufficient to cover the damages, leaving the client personally liable for the shortfall. This breaches the principle of acting in the client's best interests and could also contravene specific FCA rules regarding product governance and suitability. Another incorrect approach would be to recommend a policy with a very high limit to play it safe, even if the risk assessment does not justify such a high level, solely to avoid any potential future liability for the broker. While seemingly protective, this approach can be seen as not acting with integrity if it leads to the client paying for cover they do not reasonably need, potentially breaching the duty to provide fair value and acting in the client's best interests by not recommending the most appropriate and cost-effective solution for their actual risk profile. The professional decision-making process for similar situations should involve a structured risk assessment of the client's business, clear understanding of their operations and potential liabilities, and a transparent discussion with the client about the risks associated with different levels of cover and their implications for premium. The broker must document this advice and the client's decision, ensuring the client is fully informed of the potential consequences of choosing lower limits. This process prioritizes regulatory compliance, ethical conduct, and the long-term protection of the client. Question 4. Market research demonstrates that clients are increasingly seeking insurance solutions that are demonstrably linked to a robust understanding of their potential financial exposures. For a commercial property portfolio, which of the following approaches best exemplifies a quantitative risk assessment suitable for an advanced insurance broker advising on coverage adequacy? Option A. Engaging an external firm to perform a full actuarial valuation of all insurable assets and liabilities, without direct input from the broker on the interpretation of the findings for insurance placement. Option B. Conducting a detailed site survey of each property to identify physical hazards and then categorizing risks as low, medium, or high based on the broker's professional judgment. Option C. Presenting a broad spectrum of insurance products available in the market and allowing the client to select coverage based on their perceived needs and budget. Option D. Reviewing historical claims data for similar portfolios, analyzing industry loss trends, and using statistical methods to estimate the potential frequency and severity of future losses, thereby informing coverage limits and deductibles. The correct answer is B. Conducting a detailed site survey of each property to identify physical hazards and then categorizing risks as low, medium, or high based on the broker's professional judgment. Explanation. This scenario is professionally challenging because it requires the broker to move beyond simple risk identification to a more sophisticated quantitative assessment, balancing regulatory compliance with client needs and the inherent uncertainties of future events. The broker must demonstrate a robust understanding of how to apply quantitative methods to insurance risk without resorting to overly simplistic or purely mathematical exercises, which is a common pitfall. The core challenge lies in selecting and applying appropriate quantitative techniques that are both effective and compliant with the Advanced Insurance Broking Exam's regulatory framework, which emphasizes a practical and ethically sound application of risk assessment principles. The correct approach involves utilizing a quantitative risk assessment methodology that considers the frequency and severity of potential losses, and then translating these into potential insurance needs and appropriate coverage levels. This approach is correct because it directly addresses the quantitative aspect of risk assessment as mandated by the exam's focus. It requires the broker to analyze historical data, industry trends, and other relevant factors to estimate the probability and impact of various risks. This allows for a more informed discussion with the client about their risk appetite and the adequacy of their insurance program. Regulatory justification stems from the expectation that brokers provide advice based on a thorough understanding of the risks their clients face, which inherently involves quantitative consideration to ensure appropriate risk transfer. Ethical justification lies in the duty of care to the client, ensuring that the insurance solutions recommended are not only suitable, but also demonstrably linked to a reasoned assessment of their potential financial exposures. An incorrect approach would be to rely solely on qualitative risk assessment, such as checklists and subjective opinions, without any attempt to quantify potential loss impacts. This fails to meet the quantitative requirement of the assessment and could lead to underinsurance or overinsurance, as it lacks the data-driven insights necessary for precise risk management. The regulatory failure here is the omission of a required analytical step, potentially violating principles of due diligence and competence. Ethically, it breaches the duty of care by not providing the most informed advice possible. Another incorrect approach would be to engage in complex actuarial modeling without understanding its practical application or the client's specific context. While quantitative, this can become overly academic and detached from the client's business realities, leading to recommendations that are technically sound but practically unworkable or unaffordable. The regulatory failure is in providing advice that, while quantitatively derived, is not appropriately tailored or communicated, potentially misleading the client about the true value or applicability of the assessment. Ethically, it can be seen as a failure to communicate effectively and to provide advice that is genuinely in the client's best interest, rather than demonstrating technical prowess. A third incorrect approach would be to simply present a range of insurance products without a clear link to a structured risk assessment. This bypasses the quantitative analysis entirely, treating insurance as a commodity rather than a risk management tool. The regulatory failure is a direct contravention of the requirement to conduct a quantitative risk assessment as a foundation for advice. Ethically, it represents a significant lapse in professional responsibility, as the broker is not fulfilling their role in helping the client understand and mitigate their risks through appropriate insurance. The professional decision-making process for similar situations should involve 1. Clearly defining the scope of the quantitative risk assessment in collaboration with the client. 2. Identifying relevant data sources and analytical tools, ensuring they are appropriate for the client's industry and risk profile. 3. Applying chosen quantitative methods to estimate potential loss frequencies and severities. 4. Translating these quantitative findings into actionable insurance recommendations, clearly explaining the rationale to the client. 5. Documenting the entire process, including the data used, methodologies applied, and the basis for recommendations, to ensure transparency and accountability. Question 5. Governance review demonstrates that a senior insurance broker has a personal financial investment in an insurance company that is a potential provider of a complex commercial insurance solution for a key client. The broker is aware of this investment and its potential to influence their recommendation. What is the most appropriate course of action for the broker to ensure compliance with regulatory and ethical obligations? Option A. Recommend the insurance solution based on their professional judgment, as the financial interest is a private matter and does not directly impact the objective assessment of the product. Option B. Disclose the financial interest to the client and seek independent advice on the suitability of the proposed insurance solution before making a recommendation. Option C. Proceed with the recommendation if the financial interest is deemed minor, assuming the client's sophistication will mitigate any perceived bias. Option D. Advise the client that the broker has a financial interest in a potential provider, and allow the client to decide whether to proceed with the broker's recommendation. The correct answer is B. Disclose the financial interest to the client and seek independent advice on the suitability of the proposed insurance solution before making a recommendation. Explanation. This scenario presents a professional challenge because it requires the broker to balance commercial interests with regulatory obligations and client best interests. Challenge lies in identifying and mitigating potential conflicts of interest that can arise when a broker has a financial stake in an insurer or a related entity. Careful judgment is required to ensure that client recommendations are driven by suitability and value, not by the broker's personal or corporate financial gain. The correct approach involves establishing and adhering to a robust conflicts of interest policy that mandates disclosure, and where necessary, recusal or alternative arrangements. This approach is right because it directly addresses the regulatory requirement to act in the client's best interests and to avoid or manage conflicts of interest. Specifically, under the Advanced Insurance Broking Exams jurisdiction, assumed to be UK for this example, aligning with CISI guidelines. The FCA's Principles for Businesses, PRIN, and Conduct of Business Sourcebook, COBS, require firms to act honestly, fairly, and professionally in accordance with the best interests of their clients. Transparency and disclosure are paramount. By proactively identifying the potential conflict and seeking independent advice, the broker demonstrates a commitment to these principles, ensuring that the client's needs remain the primary consideration. An incorrect approach that involves proceeding with the recommendation without disclosing the financial interest is ethically and regulatorily unacceptable. This failure breaches the duty to act in the client's best interests and violates transparency requirements. It creates an undisclosed conflict of interest, potentially leading the client to believe the recommendation is solely based on merit when it may be influenced by the broker's financial gain. This could also contravene specific rules within COBS regarding inducements and fair treatment of clients. Another incorrect approach, which is to rely solely on the fact that the financial interest is minor and therefore not material, is also professionally unsound. The materiality of a conflict is not solely determined by its financial size, but also by its potential to influence behavior and decision-making. Even a small financial interest can create a perception of bias and undermine client trust. Regulatory frameworks often require disclosure of all potential conflicts, regardless of perceived materiality, to allow the client to make an informed decision. A third incorrect approach, which is to assume the client is sophisticated enough to understand the potential for bias without explicit disclosure, is a dangerous assumption. While client sophistication is a factor, the onus remains on the regulated firm to ensure clear and transparent communication. Regulatory expectations are that firms will proactively manage and disclose conflicts, rather than expecting clients to intuit them. The professional decision-making process for similar situations should involve a systematic approach. 1. Identify potential conflicts of interest. Proactively consider any personal, corporate, or third-party interests that could influence advice or actions. 2. Assess the nature and significance of the conflict. Determine the potential impact on client interests and regulatory obligations. 3. Implement appropriate controls. This may include disclosure, obtaining client consent, recusal from decision-making, or seeking independent advice. 4. Document all decisions and actions. Maintain a clear record of how conflicts were identified, assessed, and managed. 5. Seek guidance when in doubt. Consult compliance officers or legal counsel if the situation is complex or unclear. Question 6. Market research demonstrates that clients increasingly hold multiple, sometimes overlapping, insurance policies for the same assets. In a scenario where a client suffers a loss covered by two distinct policies from different insurers, and the broker facilitated both policies, what is the broker's primary responsibility regarding the principle of contribution? Option A. Instruct the client to choose one insurer and pursue the claim solely through that insurer, disregarding the other policy. Option B. Inform both insurers of the existence of all relevant policies and facilitate communication to ensure the loss is shared equitably according to the principle of contribution. Option C. Advise the client to claim the full loss from the insurer, offering the quickest claims settlement process. Option D. Advise the client to claim the full loss from the insurer, whose policy was arranged most recently. The correct answer is D. Advise the client to claim the full loss from the insurer whose policy was arranged most recently. Explanation: this scenario is professionally challenging because it involves multiple insurance policies covering the same risk, a situation that can lead to disputes over liability and the application of the principle of contribution. Broker's duty is to ensure clients are not underinsured or overinsured, and that claims are settled fairly and efficiently. Misunderstanding or misapplying the principle of contribution can lead to financial loss for the insured, disputes between insurers, and potential regulatory breaches for the broker. Careful judgment is required to navigate the complexities of concurrent insurance and the equitable distribution of loss. The correct approach involves understanding that the principle of contribution applies when two or more insurance policies, each covering the same risk, are in force at the time of a loss. The insured cannot recover more than their actual loss from all insurers combined. Insurers who have paid more than their ratable proportion of the loss are entitled to recover the excess from other contributing insurers. A broker's role is to facilitate this process by providing all relevant policy information to the insurers involved, ensuring transparency, and advising the client on their rights and obligations. This approach upholds the principle of indemnity and ensures fair treatment of all parties, aligning with regulatory expectations for professional conduct and fair claims handling. An incorrect approach would be to advise the client to claim the full amount from only one insurer, ignoring the existence of other policies. This fails to acknowledge the principle of contribution, potentially leading to one insurer being overburdened and others escaping their rightful liability. This is a regulatory failure as it misrepresents the client's position and can lead to unfair claims settlement. Another incorrect approach would be to suggest that the client can recover the full loss from each insurer independently. This directly violates the principle of indemnity and the principle of contribution, as it would allow the client to profit from the loss. This constitutes a significant ethical and regulatory failure, as it encourages fraudulent claims and breaches the duty of utmost good faith. A further incorrect approach would be for the broker to refuse to engage with the insurers regarding the contribution issue, stating it is a matter solely between the insurers. While the ultimate settlement of contribution is between insurers, the broker has a duty to facilitate the claims process and ensure all relevant information is shared. Withholding information or failing to act as a conduit for communication is a dereliction of duty and can lead to delays and disputes, potentially breaching regulatory requirements for client support and fair dealing. Professionals should use a decision-making framework that prioritizes understanding the client's contractual obligations and the principles of insurance law. This involves 1. Identifying all relevant policies covering the loss. 2. Understanding the principle of contribution and its application to the specific policies. 3. Communicating transparently with all involved insurers, providing them with details of all concurrent policies. 4. Advising the client on the implications of contribution for their claim settlement. 5. Facilitating communication and negotiation between insurers if necessary, acting in the client's best interest while upholding regulatory and ethical standards. Question 7. The evaluation methodology shows that an insurance broker operating in the United Kingdom must adhere to the oversight of multiple regulatory bodies. Considering the distinct mandates of the Financial Conduct Authority, FCA, and the Prudential Regulation Authority, PRA, which of the following approaches best reflects the broker's obligation to comply with both regulatory frameworks? Option A. Primarily engaging with the FCA for all client-facing and operational compliance matters, as they are the primary conduct regulator. Option B. Focusing exclusively on the PRA's prudential requirements to ensure the firm's financial stability and solvency. Option C. Differentiating regulatory responsibilities, engaging with the FCA for conduct of business rules and client protection, and with the PRA for prudential supervision and financial stability, ensuring compliance with each body's specific remit. Option D. Developing a unified compliance strategy that treats the FCA and PRA as having interchangeable oversight responsibilities for all aspects of the brokerage business. The correct answer is A. Primarily engaging with the FCA for all client-facing and operational compliance matters, as they are the primary conduct regulator. Explanation. This scenario is professionally challenging because it requires a broker to navigate the distinct regulatory oversight responsibilities of two primary insurance regulatory bodies within the United Kingdom: the Financial Conduct Authority, FCA, and the Prudential Regulation Authority, PRA. The broker must understand which body has primary responsibility for different aspects of their operations and client interactions, particularly concerning conduct of business versus prudential matters. Careful judgment is required to ensure compliance with all applicable rules and to avoid regulatory breaches. The correct approach involves accurately identifying the respective remits of the FCA and the PRA. The FCA is responsible for regulating the conduct of financial services firms, including insurance brokers, ensuring they treat customers fairly and operate with integrity. The PRA, on the other hand, focuses on the prudential regulation of firms, ensuring their financial stability and solvency to protect policyholders. Therefore, a broker must engage with both bodies as appropriate, understanding that the FCA will govern their day-to-day client dealings and sales practices, while the PRA will oversee their capital adequacy and risk management. This dual engagement ensures comprehensive regulatory adherence. An incorrect approach that focuses solely on the FCA would fail to address the prudential requirements mandated by the PRA, potentially leading to breaches related to capital management, solvency, and financial resilience. This oversight could jeopardize the firm's financial stability and, by extension, the security of policyholder assets. Conversely, an approach that prioritizes only the PRA's prudential requirements would neglect the crucial conduct of business rules enforced by the FCA, risking consumer detriment, mis-selling, and reputational damage. A third incorrect approach, attempting to merge the distinct functions of both regulators into a single point of contact or compliance strategy without understanding their specific mandates, would lead to confusion, inefficiency, and likely non-compliance with the detailed requirements of each body. Professionals should adopt a decision-making framework that begins with a thorough understanding of the regulatory landscape. This involves clearly delineating the responsibilities of each relevant regulatory body. For insurance brokers in the UK, this means distinguishing between the FCA's conduct regulation and the PRA's prudential regulation. When faced with a situation involving both aspects, the professional should consult the specific guidance and rules issued by each regulator, seeking clarification from the regulators themselves if necessary. A proactive approach to understanding these distinct roles and their implications for the firm's operations is essential for maintaining compliance and ethical standards. Question 8. The risk matrix shows a moderate likelihood of increased claims frequency for a specific policy type. The client is requesting a significant premium reduction, citing competitive market offerings. The broker needs to determine the most appropriate way to respond to the client's request while adhering to regulatory requirements and professional standards. Option A. Immediately agree to the client's requested premium reduction to secure the business, assuming the insurer will absorb any potential losses. Option B. Advise the client that premium reductions are not possible due to the increased risk, without exploring alternative pricing structures or insurer capabilities. Option C. Focus solely on matching the competitor's lower premium, irrespective of the insurer's pricing models or the product's long-term sustainability. Option D. Advocate for a premium reduction that is supported by the insurer's actuarial assessment of the product's long-term financial viability, understanding that such assessments implicitly consider future cash flows and profitability. The correct answer is D. Advocate for a premium reduction that is supported by the insurer's actuarial assessment of the product's long-term financial viability, understanding that such assessments implicitly consider future cash flows and profitability. Explanation. This scenario is professionally challenging because it requires the broker to balance the client's immediate desire for a lower premium with the long-term financial implications and regulatory obligations. The broker must ensure that any proposed premium reduction is justifiable and sustainable, not merely a short-term incentive that could lead to future financial instability for the insurer or misrepresentation to the client. The core of the challenge lies in applying a robust risk assessment methodology that considers the future financial health of the insurance product, which is where discounted cash flow, DCF, analysis becomes relevant, even if not explicitly calculated by the broker. The correct approach involves understanding how a DCF analysis, even if performed by the insurer, informs the pricing of the insurance product and therefore the premium. A broker's role is to understand the underlying assumptions and implications of such analyses on the product's viability and the client's long-term benefit. The broker should advocate for a premium that reflects a sustainable pricing model, informed by the insurer's actuarial assessments, which implicitly or explicitly use DCF principles to project future cash flows and determine the present value of liabilities and expected profits. This aligns with the regulatory duty to act in the client's best interest and to ensure fair treatment of customers, preventing the offering of products that are priced unsustainably low, which could lead to future premium increases or policy cancellation. An incorrect approach would be to solely focus on achieving the lowest possible premium for the client, without considering the underlying financial sustainability of that premium. This might involve pressuring the insurer for a discount that is not supported by the insurer's risk assessment and pricing models, which are informed by DCF principles. Such an approach could lead to the broker misrepresenting the product's value or sustainability to the client, potentially breaching regulatory requirements related to fair dealing and accurate product information. Another incorrect approach would be to ignore the insurer's pricing rationale entirely and simply accept a premium that appears attractive without understanding its basis, failing to exercise due diligence in assessing the suitability and sustainability of the insurance product for the client. This demonstrates a lack of professional judgment and a failure to uphold the broker's responsibility to understand the products they offer. Professional decision-making in such situations requires a framework that prioritizes understanding the product's financial underpinnings, even if the broker doesn't perform the DCF calculation themselves. This involves engaging with the insurer to understand their pricing methodologies, assessing the long-term implications of proposed premiums, and ensuring that any recommendations made to the client are both competitive and financially sound, thereby fulfilling regulatory obligations and ethical duties. Question 9. What factors determine the extent to which an insurance broker must proactively explain policy limitations and exclusions to a consumer, beyond simply providing the policy document, to ensure compliance with consumer protection laws? Option A. The insurer's standard operating procedures for policy disclosure, regardless of the consumer's individual needs. Option B. The broker's personal opinion on whether the consumer is likely to understand complex policy wording. Option C. The complexity and relevance of the limitations/exclusions to the consumer's stated needs and circumstances, and the broker's professional duty to ensure informed consent. Option D. The minimum disclosure requirements stipulated in the policy wording itself, without additional proactive explanation. The correct answer is C. The complexity and relevance of the limitations/exclusions to the consumer's stated needs and circumstances, and the broker's professional duty to ensure informed consent. Explanation. This scenario is professionally challenging because it requires a broker to balance the commercial interests of the insurer with the fundamental duty to protect the consumer. The broker must navigate potential conflicts of interest and ensure that the consumer's understanding and consent are paramount, even when faced with pressure to secure a sale or maintain a profitable relationship with an insurer. Careful judgment is required to avoid misrepresentation, ensure fair treatment, and uphold the principles of good faith inherent in insurance broking. The correct approach involves proactively identifying and clearly communicating to the consumer any potential limitations or exclusions in the policy that are particularly relevant to their stated needs and circumstances. This includes explaining the practical implications of these limitations in plain language, ensuring the consumer understands what is not covered and why. This aligns with regulatory requirements for clear and fair communication, preventing misleading statements, and ensuring consumers make informed purchasing decisions. It upholds the ethical duty of care and transparency expected of a professional broker. An incorrect approach that focuses solely on the policy's technical wording, without explaining its practical impact on the consumer's specific situation, fails to meet the standard of clear communication. This can lead to a consumer believing they have coverage that does not, in fact, exist, resulting in a breach of consumer protection laws related to misrepresentation and misleading conduct. Another incorrect approach that prioritizes securing the sale by downplaying or omitting discussion of significant exclusions or limitations is a direct contravention of consumer protection principles. This constitutes misleading conduct and a failure to act in the consumer's best interest, potentially leading to significant financial detriment for the consumer and regulatory sanctions for the broker. A further incorrect approach that relies on the consumer to read and understand the entire policy document without any proactive explanation of key terms or limitations fails to discharge the broker's duty of care. While consumers have a responsibility to read their policies, brokers have a professional obligation to facilitate understanding, especially regarding terms that materially affect the coverage relevant to the consumer's stated needs. The professional decision-making process for similar situations should involve a structured approach. First, thoroughly understanding the consumer's needs and risk profile. Second, identifying policies that best match these needs, paying close attention to any limitations or exclusions. Third, proactively and clearly communicating these limitations and their practical implications to the consumer in a manner they can understand. Fourth, obtaining explicit confirmation of understanding and consent. And finally, documenting all advice and communications. Question 10. Examination of the data shows that a commercial client operates a retail store housed in a leased property. The client has requested insurance for their business premises, emphasizing the need to cover the physical structure of the shop. They have provided a figure for the estimated cost to rebuild the building. However, they have not provided specific details regarding the value of the stock, fixtures, fittings, and equipment housed within the premises. Based on the regulatory framework for the Advanced Insurance Broking Exam, which approach to advising the client on coverage for buildings and contents is most appropriate. Option A. Advise the client to insure the building for the provided reinstatement cost and include a general, broad sum insured for contents based on a typical retail business of this size, assuming the client will clarify if specific high-value items exist. Option B. Advise the client to insure the building for the provided reinstatement cost and suggest a contents sum insured that is a fixed percentage of the building's reinstatement cost, as this is a common industry practice. Option C. Focus solely on insuring the building for the reinstatement cost as requested, and inform the client that contents insurance is a separate consideration they must manage independently. Option D. Recommend insuring the building for the provided reinstatement cost, and strongly advise the client to obtain a professional valuation of all contents, including stock, fixtures, fittings, and equipment, to establish an accurate sum insured for each category. The correct answer is A. Advise the client to insure the building for the provided reinstatement cost and include a general, broad sum insured for contents based on a typical retail business of this size, assuming the client will clarify if specific high-value items exist. Explanation. This scenario is professionally challenging because it requires the broker to balance the client's perceived needs with the actual risks and the insurer's underwriting requirements, all within the strict confines of the Advanced Insurance Broking Exam's regulatory framework. Misinterpreting the scope of coverage for buildings and contents can lead to significant underinsurance, leaving the client exposed to financial loss and potentially damaging the broker-client relationship and the broker's professional reputation. Careful judgment is required to ensure the policy accurately reflects the insurable interest and the value of the assets. The correct approach involves a thorough assessment of both the physical structure of the building and the movable items within it, ensuring that the sum insured for each is adequate and reflects their current market value. This aligns with the regulatory duty of care to act in the client's best interests, which includes providing advice that leads to appropriate and sufficient cover. Specifically, the broker must ensure that the policy wording clearly distinguishes between buildings and contents, and that the sums insured are based on a realistic valuation, not just a general estimate. This proactive approach prevents potential disputes at the claims stage and upholds the principles of good broking practice as mandated by the exam's regulatory framework. An incorrect approach that focuses solely on the building's reinstatement cost without considering the value of contents would fail to provide comprehensive protection. This neglects the client's potential loss of personal or business property, leading to underinsurance of contents. Another incorrect approach that relies on a generic contents sum insured without specific inquiry into the nature and value of the items would also be professionally deficient. This could result in inadequate cover for high-value items, contravening the duty to advise on appropriate levels of cover. Furthermore, an approach that assumes the client understands the distinction between buildings and contents and their respective valuation methods without providing clear guidance would be a failure of the broker's advisory responsibility. This lack of clarity can lead to the client making incorrect assumptions about their coverage. Professional decision-making in such situations requires a systematic process. First, understanding the client's business and assets. Second, identifying all potential insurable risks related to both the property and its contents. Third, advising the client on the appropriate types of cover and valuation methods, ensuring they understand the implications of each. And finally, documenting all advice and decisions made. This ensures transparency and compliance with regulatory expectations. Question 11. When evaluating different term life insurance policies for a client who has expressed a strong desire for future flexibility and the potential to convert their cover without a medical examination, which approach best demonstrates compliance with the FCA's regulatory framework for providing advice on life insurance products? Option A. Conducting a detailed comparative analysis of the conversion options, terms, conditions, and available riders across various policies, and clearly explaining the implications of these features to the client. Option B. Prioritizing policies with the lowest initial premium, assuming future conversion needs can be met by purchasing a new policy if required. Option C. Focusing on policies with the longest term lengths, as this inherently provides greater long-term security and flexibility. Option D. Recommending a policy with a basic level of cover and a standard conversion option, as this is generally sufficient for most clients seeking term life insurance. Correct answer is B. Prioritizing policies with the lowest initial premium, assuming future conversion needs can be met by purchasing a new policy if required. Explanation. This scenario is professionally challenging because it requires the broker to navigate the nuances of term life insurance products, specifically the differing riders and conversion options, while adhering strictly to the regulatory framework governing insurance advice in the UK. The broker must ensure that the advice provided is not only suitable for the client's stated needs, but also fully compliant with the Financial Conduct Authority's (FCA) principles and rules, particularly those related to product governance, suitability, and disclosure. The client's desire for flexibility and potential future needs introduces complexity, demanding a thorough understanding of how different term life policies address these evolving circumstances. The correct approach involves a detailed comparative analysis of the term life insurance policies, focusing on the specific features and benefits of each, particularly the conversion options and any available riders that enhance flexibility. This approach aligns with FCA Principle 3, Customers' Interests, and Principle 6, Communicating with Clients, as well as the detailed requirements under the Conduct of Business Sourcebook, COBS, for providing advice on regulated products. Specifically, COBS 9A, Suitability, mandates that a firm must assess the client's knowledge and experience, financial situation, and needs and objectives, and then recommend a product that is suitable. A deep dive into the conversion rights, including the terms, conditions, and any limitations, is crucial for ensuring the client understands their future options and that the recommended policy truly meets their long-term objectives for flexibility. An incorrect approach that focuses solely on the initial premium cost without adequately exploring the conversion rights or the implications of different riders fails to meet the suitability requirements. This would breach FCA Principle 6 by not ensuring clear, fair, and not misleading communication, and COBS 9A by not adequately assessing the client's needs and objectives concerning future flexibility. Another incorrect approach that prioritizes a policy with a slightly lower initial premium but significantly more restrictive conversion terms or fewer beneficial riders, without clearly explaining these trade-offs to the client, would also be a failure. This neglects the client's stated need for flexibility and could lead to a policy that is not suitable in the long term, violating FCA Principle 3 and COBS 9A. A professional decision-making process for similar situations should begin with a comprehensive fact-find to fully understand the client's current circumstances, future aspirations, and risk tolerance. This should be followed by a thorough research and comparison of available products, focusing on how each product addresses the client's identified needs and objectives, particularly regarding flexibility and potential future changes. The broker must then clearly articulate the features, benefits, risks, and costs of each suitable option to the client, ensuring they understand the implications of their choices, especially concerning conversion rights and rider benefits. The final recommendation must be demonstrably linked to the client's individual circumstances and needs, with clear documentation to support the advice given. Question 12. Benchmark analysis indicates that a significant number of policy issuance errors stem from inadequate documentation verification. In the context of advanced insurance broking, which of the following approaches best ensures regulatory compliance and client protection during the policy issuance process, assuming the jurisdiction is the United Kingdom and governed by the Financial Conduct Authority, FCA Handbook? Option A. Relying exclusively on the insurer's automated system to generate and dispatch all policy documents to the client without broker review, assuming the system is compliant. Option B. Proceeding with policy issuance based on an incomplete proposal form, with a commitment to obtain the missing details from the client and update the insurer post-issuance. Option C. Issuing the policy immediately upon receiving a verbal confirmation from the client and a preliminary email from the insurer, with the understanding that all formal documentation will be processed and sent later. Option D. Ensuring all required documentation, including a signed proposal form, pre-contractual information, and the final policy wording, is reviewed and confirmed by the broker and provided to the client and insurer before coverage commences. The correct answer is C. Issuing the policy immediately upon receiving a verbal confirmation from the client and a preliminary email from the insurer, with the understanding that all formal documentation will be processed and sent later. Explanation. Scenario analysis. This scenario is professionally challenging because it requires the broker to balance the client's immediate desire for coverage with the absolute necessity of adhering to regulatory requirements for policy issuance. The pressure to secure business quickly can sometimes lead to overlooking crucial documentation steps. Failure to comply with these requirements can result in regulatory sanctions, reputational damage, and potential financial loss for both the broker and the client. The broker must exercise sound judgment to ensure all legal and ethical obligations are met before the policy is considered active. Correct approach analysis. The correct approach involves ensuring that all required documentation, including the signed proposal form, any pre-contractual information, and the policy wording itself, are provided to the client and formally accepted by the insurer before the policy is issued and coverage commences. This aligns with the regulatory framework that mandates clear communication and evidence of agreement between all parties. Specifically, it upholds the principles of transparency, due diligence, and the insurer's obligation to provide clear terms and conditions. The broker's role is to facilitate this process, ensuring that the client understands what they are purchasing and that the insurer has all necessary information to underwrite the risk accurately. This proactive approach minimizes the risk of disputes and ensures regulatory compliance. Incorrect approach is analysis. Issuing a policy based solely on a verbal agreement or a preliminary email confirmation without obtaining signed documentation from the client and formal acceptance from the insurer is a significant regulatory and ethical failure. This bypasses the requirement for documented evidence of the client's intent and the insurer's commitment, leaving both parties exposed. It violates principles of good faith and transparency, as the client may not fully understand the terms, and the insurer may be bound by coverage not properly underwritten. Proceeding with policy issuance based on an incomplete proposal form, even with the intention to obtain the missing information later, is also problematic. This creates a risk of misrepresentation or non-disclosure if the missing information is material to the risk. It also fails to meet the regulatory expectation that all necessary information is gathered and assessed prior to binding coverage. The insurer's ability to underwrite the risk effectively is compromised, and the client may not receive appropriate coverage or may be charged an incorrect premium. Relying solely on the insurer's automated system to generate policy documents without the broker's verification that all client-specific requirements and regulatory disclosures have been correctly incorporated is another failure. While automation can be efficient, it does not absolve the broker of their responsibility to ensure the accuracy and completeness of the documentation provided to the client. The broker must act as an intermediary, ensuring that the policy accurately reflects the agreed terms and complies with all applicable regulations, not just blindly accepting system-generated output. Professional reasoning. Professionals should adopt a systematic approach to policy issuance. This involves 1. Verifying that all necessary information has been collected from the client, including a signed proposal form. 2. Ensuring the insurer has formally accepted the risk and provided all relevant policy documentation. 3. Reviewing the policy wording and any endorsements to confirm they accurately reflect the client's needs and the agreed terms. 4. Providing the client with all policy documents, including the schedule, wording, and any pre-contractual information, in a clear and understandable format. 5. Obtaining confirmation from the client that they have received and understood the documentation. This structured process ensures compliance, protects the client, and upholds the integrity of the broking profession. Question 13. The efficiency study reveals that a particular insurer, while offering a slightly lower commission rate to brokers, consistently provides superior policy terms and a more responsive claims handling service compared to other insurers in the market. A client approaches your brokerage seeking comprehensive business insurance. You have identified several policies that meet the client's stated needs, but the insurer with the superior service and terms offers a commission that is 2% lower than the average commission offered by other suitable insurers. How should you proceed to ensure compliance with regulatory and ethical obligations? Option A. Recommend the insurer with superior policy terms and claims handling, clearly explaining the rationale to the client and disclosing all relevant commission information. Option B. Recommend a mix of insurers, prioritizing those with higher commission rates and only mentioning the insurer with superior terms as a secondary, less attractive option. Option C. Focus solely on the commission rates when presenting options to the client, advising them to choose the policy with the highest potential payout for the brokerage. Option D. Recommend the insurer offering the highest commission, as this is standard practice for maximizing brokerage revenue and is not explicitly prohibited if the policy meets minimum requirements. The correct answer is A. Recommend the insurer with superior policy terms and claims handling, clearly explaining the rationale to the client and disclosing all relevant commission information. Explanation. This scenario presents a professional challenge because it requires the broker to navigate potential conflicts of interest and ensure that client best interests are prioritized, as mandated by regulatory frameworks governing insurance broking. Broker must act with integrity and transparency, avoiding any actions that could be perceived as favoring one insurer over another for reasons other than the client's needs and the suitability of the product. The correct approach involves the broker diligently researching and presenting a range of suitable insurance products from different insurers that meet the client's specific requirements and risk profile. This approach aligns with the broker's fiduciary duty to the client, which is a cornerstone of regulatory compliance, specifically under the Advanced Insurance Broking Exams jurisdiction, assumed to be UK/SISI for this context. The Financial Conduct Authority, FCA Handbook, particularly the Conduct of Business Cobb's Sourcebook, mandates that firms must act honestly, fairly, and professionally in accordance with the best interests of their clients. This includes providing clear, fair, and not misleading information and making suitable recommendations. Presenting multiple options from various insurers, even if one offers a slightly lower commission, demonstrates a commitment to client best interests and avoids potential breaches of conduct rules related to conflicts of interest and product suitability. An incorrect approach would be to exclusively recommend the insurer offering the highest commission, even if other insurers offer comparable or superior products for the client's needs. This action would likely breach FCA principles, specifically Principle 7, Communications with Clients, and Principle 8, Conflicts of Interest, by failing to act in the client's best interests and potentially prioritizing the broker's financial gain over the client's. Another incorrect approach would be to downplay the benefits of products from insurers with lower commission rates, thereby misleading the client and failing to provide a fair comparison. This contravenes the requirement for clear, fair, and not misleading communications. Furthermore, failing to disclose the commission structure or any potential conflicts of interest to the client would be a significant regulatory and ethical failing, undermining transparency and trust. Professionals should employ a decision-making framework that begins with a thorough understanding of the client's needs, risk appetite, and financial situation. This should be followed by a comprehensive market analysis to identify suitable products from a diverse range of insurers. Any potential conflicts of interest, such as differential commission rates, must be identified and managed transparently, with full disclosure to the client. The ultimate decision should always be guided by what is demonstrably in the client's best interests, supported by clear and objective reasoning, and documented appropriately. Question 14. Regulatory review indicates that a client wishes to insure a valuable piece of art that is currently on loan to a museum. The client is the owner of the art, but has no immediate financial gain from its display at the museum, nor is there a contractual obligation for the museum to pay for any damage. The client anticipates selling the art in the future, but no sale is currently pending. Which approach best upholds the principle of insurable interest? Option A. Arrange insurance for the client, as their ownership of the art establishes a clear insurable interest, and they stand to suffer a financial loss if the art is damaged or lost. Option B. Advise the client that insurable interest is questionable due to the lack of immediate financial benefit or contractual obligation related to the loan, and suggest exploring options for the museum to insure the art. Option C. Recommend that the client obtain a valuation of the art and insure it for a sum that reflects its potential future sale price, regardless of current financial connections. Option D. Proceed with arranging insurance based on the client's sentimental attachment to the art and their future intention to sell it. The correct answer is A. Arrange insurance for the client, as their ownership of the art establishes a clear insurable interest, and they stand to suffer a financial loss if the art is damaged or lost. Explanation. This scenario presents a professional challenge, because it requires the broker to navigate the nuanced application of the insurable interest principle in a situation where the financial connection is indirect and potentially subject to change. The broker must exercise careful judgment to ensure that the proposed insurance contract is valid and enforceable, adhering strictly to the regulatory framework governing insurance in the specified jurisdiction. Failure to do so could lead to a void policy, regulatory sanctions, and reputational damage. The correct approach involves identifying a direct financial or legal relationship between the proposed insured and the subject matter of the insurance. This relationship must exist at the time of the loss. The broker's responsibility is to ascertain that the client has a legitimate stake in the preservation of the insured item or event, such that they would suffer a financial detriment if the insured event occurred. This aligns with the fundamental principle of insurable interest, which prevents speculative insurance and ensures that insurance serves a protective rather than a gambling purpose, as mandated by the relevant insurance legislation and regulatory guidelines. An incorrect approach would be to proceed with arranging insurance based solely on a sentimental attachment or a vague hope of future benefit. This fails to establish the legally required financial or pecuniary interest. Another incorrect approach would be to assume insurable interest exists without due diligence, relying on the client's assertion without independent verification of the nature and extent of their connection to the insured subject matter. This demonstrates a lack of professional care and a potential breach of regulatory duty to advise appropriately and ensure policy validity. A further incorrect approach would be to arrange cover for a party who has no demonstrable financial stake in the insured asset or event, even if they are acting on behalf of someone who does, without ensuring the policy is structured to reflect the true beneficiary of the insurable interest. This could lead to the policy being voidable at the outset. Professionals should employ a decision-making framework that prioritizes understanding the client's specific circumstances and the nature of their relationship to the risk. This involves asking probing questions to establish the existence and extent of a financial or legal interest, cross-referencing this with the specific requirements of the relevant insurance legislation and regulatory guidance, and documenting the rationale for the advice provided. If doubt remains, seeking clarification from the insurer or a compliance officer is a prudent step. Question 15. The control framework reveals that a sedent insurer is experiencing significant liquidity pressures and proposes to enter into a reinsurance agreement with a newly established reinsurer. The proposed agreement appears to offer substantial upfront premium financing and a retrospective profit-sharing arrangement that could significantly improve the sedent's reported profitability and cash flow in the short term. However, the terms of the risk transfer are complex and potentially ambiguous, and the financial strength of the new reinsurer has not been independently verified. The broker is asked to facilitate this arrangement. Which of the following approaches best aligns with the advanced insurance broking exam's regulatory framework and ethical guidelines? Option A. Facilitate the agreement as proposed, prioritizing the sedent's immediate liquidity needs and accepting the reinsurer's assurances regarding its financial capacity and the nature of the risk transfer. Option B. Proceed with the agreement, but advise the sedent to make a note in their financial statements acknowledging the potential uncertainties surrounding the reinsurance arrangement. Option C. Advise the sedent that, while the immediate financial benefits are attractive, a thorough due diligence on the reinsurer's financial stability and a detailed review of the risk transfer provisions are essential to ensure regulatory compliance and long-term solvency before proceeding. Option D. Recommend that the sedent seek alternative, more conventional reinsurance solutions that offer clearer risk transfer and are placed with established reinsurers, even if these solutions do not provide the same immediate cash flow benefits. The correct answer is A. Facilitate the agreement as proposed, prioritizing the sedent's immediate liquidity needs and accepting the reinsurer's assurances regarding its financial capacity and the nature of the risk transfer. Explanation: this scenario is professionally challenging because it requires the broker to balance the client's immediate financial pressures with their long-term solvency and regulatory obligations. The broker must exercise sound judgment to ensure that the reinsurance arrangements, while meeting the client's cash flow needs, do not compromise the client's ability to meet its future claims obligations or violate regulatory solvency requirements. The core tension lies in the potential for a short-term financial fix to create a long-term systemic risk for the insurer. The correct approach involves a thorough assessment of the proposed reinsurance structure's impact on the sedent's solvency and financial stability, ensuring compliance with all relevant regulatory solvency capital requirements and reporting obligations. This approach prioritizes the long-term health of the insurer and the protection of policyholders, aligning with the fundamental principles of insurance regulation. Specifically, it requires the broker to verify that the reinsurance contract is a genuine transfer of risk, not merely a financial transaction designed to manipulate balance sheet figures. This includes scrutinizing the terms, conditions, and pricing of the reinsurance to ensure they are commercially reasonable and reflect the actual risk transferred. Regulatory justification stems from the overarching duty of insurers to maintain adequate solvency margins and to conduct their business in a manner that does not jeopardize policyholder interests. The broker's role in facilitating such arrangements necessitates a fiduciary responsibility to ensure these arrangements are sound and compliant. An incorrect approach that focuses solely on the sedent's immediate cash flow needs without adequately assessing the solvency implications would be professionally unacceptable. This failure would breach the broker's duty of care and potentially lead to regulatory breaches if the reinsurance arrangement is deemed non-compliant with solvency rules, such as those requiring a genuine transfer of risk. Another incorrect approach, which involves accepting the reinsurer's assurances without independent verification of their financial strength and capacity to pay claims, is also problematic. This oversight could expose the cedent to significant counterparty risk, leaving them exposed if the reinsurer defaults, thereby jeopardizing policyholder protection and solvency. Furthermore, failing to ensure that the reinsurance contract is properly documented and disclosed in accordance with regulatory reporting requirements would constitute a significant ethical and regulatory lapse, undermining transparency and the integrity of financial reporting. Professionals should adopt a decision-making framework that begins with a comprehensive understanding of the client's financial position and strategic objectives. This should be followed by a rigorous evaluation of any proposed reinsurance structure, focusing on its impact on solvency, risk transfer, and regulatory compliance. Independent due diligence on reinsurers is crucial, and all arrangements must be documented and disclosed in accordance with regulatory mandates. The broker's ultimate responsibility is to act in the best interests of the client while upholding regulatory standards and protecting policyholder security. Question 16. The performance metrics show a consistent trend of clients requesting the most basic and cheapest personal insurance policies, often overlooking potential gaps in cover. A long-standing client who has previously purchased a comprehensive home insurance policy now insists on a significantly reduced level of cover for their new property, citing a desire to minimize monthly outgoings. The broker believes this reduced cover will leave the client inadequately protected against common risks associated with their new property type. What is the most appropriate course of action for the broker? Option A. Advise the client on the risks and limitations of the reduced cover. Explain why a more comprehensive policy is recommended based on their specific circumstances and the property's characteristics, and present both options clearly, allowing the client to make an informed decision. Option B. Proceed with the client's requested policy, as their explicit instruction overrides the broker's professional opinion on the level of cover required. Option C. Recommend a policy with a slightly higher premium than the client's initial request, arguing it offers better value without fully explaining the specific risks of the client's preferred lower cover. Option D. Inform the client that their request cannot be met due to the broker's professional assessment of their inadequate needs, and refuse to place the business. The correct answer is A. Advise the client on the risks and limitations of the reduced cover. Explain why a more comprehensive policy is recommended based on their specific circumstances and the property's characteristics, and present both options clearly, allowing the client to make an informed decision. Explanation. This scenario presents a professional challenge because the broker must balance the client's stated preferences with their actual needs and the regulatory obligations to provide suitable advice. The client's desire for a specific, potentially inadequate, policy based on a misunderstanding of their risk profile creates a conflict between client satisfaction and professional duty. Careful judgment is required to navigate this by ensuring the client is fully informed and that the recommended product aligns with their genuine insurance requirements, not just their initial, possibly misinformed, request. The correct approach involves a thorough needs analysis that goes beyond the client's initial stated preference. This requires the broker to actively probe the client's circumstances, understand their risk exposures, and explain the rationale behind recommending a policy that offers more comprehensive cover, even if it differs from their initial request. This aligns with the regulatory framework's emphasis on treating customers fairly and ensuring that advice provided is suitable and in the client's best interests. Specifically, under the FCA's Financial Conduct Authority, Conduct of Business Sourcebook COBS, particularly COBS 9, Suitability, brokers have a duty to ensure that any product recommended is appropriate for the client's needs, knowledge, and experience. This necessitates a detailed assessment of the client's situation and a clear explanation of why a particular product is suitable. An incorrect approach that simply accepts the client's initial request without further investigation fails to meet the regulatory standard of suitability. This would be a breach of COBS 9, as it prioritizes the client's potentially uninformed preference over their actual insurance needs, thereby not acting in the client's best interests. Another incorrect approach, which involves pressuring the client into a more expensive policy without a clear, client-centric justification, could be seen as mis-selling or failing to treat customers fairly, also contravening FCA principles and COB's requirements. Finally, an approach that focuses solely on the premium amount without adequately assessing the scope of cover and the client's risk profile would also be a regulatory failure, as it neglects the fundamental purpose of insurance to provide adequate protection. Professional decision-making in such situations should follow a structured process. First, actively listen to and understand the client's stated needs and preferences. Second, conduct a comprehensive fact-finding exercise to gather all relevant information about the client's circumstances and risk exposures. Third, analyze this information to determine the client's actual insurance needs. Fourth, identify suitable products that meet these needs, considering factors like cover, cost, and policy terms. Fifth, clearly explain the recommended product S to the client, detailing the benefits, limitation, and the rationale for the recommendation, especially if it differs from their initial request. Finally, ensure the client understands and agrees with the recommendation, documenting the advice provided. Question 17. Process analysis reveals that a broker is approached by a new client, a sheep farmer, seeking livestock insurance. The farmer has a flock of 500 breeding ewes and 100 lambs. The broker's initial inclination is to provide a quote based on the total number of animals and their general breed, without further inquiry into the farm's specific health protocols, biosecurity measures, or recent disease history. Which of the following approaches represents the most appropriate risk assessment strategy for this scenario? Option A. Provide a quote based solely on the total number of animals and their general breed, assuming a standard risk profile for this type of livestock. Option B. Conduct a thorough on-site inspection of the farm, discuss the farmer's herd health records, biosecurity measures, feeding regimes, and local environmental risks with the farmer. Option C. Rely exclusively on historical claims data from other sheep farms in the region to determine the appropriate premium and coverage. Option D. Utilize a generic online questionnaire that covers basic livestock numbers and age, prioritizing speed and efficiency in generating a quote. The correct answer is B. Conduct a thorough on-site inspection of the farm, discuss the farmer's herd health records, biosecurity measures, feeding regimes, and local environmental risks with the farmer. Explanation: this scenario is professionally challenging because assessing the risk for livestock insurance requires a nuanced understanding of biological factors, environmental influences, and the specific management practices of the insured. A broker must go beyond superficial data to identify potential vulnerabilities that could lead to claims. Careful judgment is required to balance the need for comprehensive risk assessment with the practicalities of the client's operations and the cost-effectiveness of insurance. The correct approach involves a thorough on-site inspection and detailed discussion with the farmer regarding their herd's health records, biosecurity measures, feeding regimes, and local environmental risks such as disease prevalence or extreme weather patterns. This aligns with the regulatory expectation for brokers to conduct adequate due diligence and provide advice that is suitable for the client's specific circumstances. The Financial Conduct Authority (FCA) Handbook, specifically in the Conduct of Business COB's Sourcebook, mandates that firms must act honestly, fairly, and professionally in accordance with the best interests of their clients. This includes understanding the client's needs and the risks associated with the product being recommended. For livestock insurance, this translates to a deep dive into the operational risks that could impact the insured animals. An incorrect approach that focuses solely on the number of animals and their general breed without considering specific health history or management practices fails to meet the duty of care. This oversight could lead to underinsurance or the provision of inappropriate coverage, potentially breaching COB's 9A. 2.1r, which requires firms to ensure that advice given is appropriate for the client. Another incorrect approach that relies solely on historical claims data from similar farms, without verifying the current practices of the specific farm, is also professionally deficient. While historical data is useful, it does not account for changes in management, herd health, or local environmental conditions that could significantly alter the risk profile. This could be seen as a failure to gather sufficient information to make a suitable recommendation, contravening the principles of fair treatment of customers. A third incorrect approach that prioritizes speed and ease of quoting over a detailed risk assessment, perhaps by using a generic questionnaire, neglects the inherent complexities of livestock insurance. This approach risks mispricing the policy, leading to either excessive premiums for the client or inadequate coverage, and ultimately failing to act in the client's best interests. This demonstrates a lack of professional diligence and could be viewed as a breach of the overarching principles of treating customers fairly. Professionals should adopt a systematic decision-making process that begins with understanding the client's business and their specific risk exposures. This involves active listening, asking probing questions, and conducting necessary investigations, like on-site visits. The information gathered should then be used to identify suitable insurance products and to advise the client on the most appropriate coverage and risk mitigation strategies, always ensuring compliance with regulatory requirements, suitability, and client best interests. Question 18. Research into a client's medical expense insurance claim reveals that the insurer has denied coverage for a specific treatment, citing it as a pre-existing condition not disclosed at the time of application. The client vehemently disputes this, stating they were unaware of the condition and that the treatment is essential. As the client's broker, what is the most appropriate course of action to ensure the client's interests are protected and regulatory compliance is maintained? Option A. Immediately advise the client to seek legal counsel and initiate a formal dispute resolution process, as the insurer's denial indicates a likely breach of contract. Option B. Accept the insurer's decision as final, as pre-existing condition clauses are standard and often difficult to contest, and focus on finding alternative, out-of-pocket solutions for the client. Option C. Advise the client to thoroughly review their policy wording, specifically the definitions of pre-existing conditions and medical expenses, and then facilitate a detailed discussion with the insurer, providing all supporting medical evidence and requesting a formal review of the decision based on the policy terms and the client's documented medical history. Option D. Encourage the client to accept a reduced settlement offer from the insurer, explaining that this is a common compromise in such disputes and will provide some financial relief. The correct answer is C. Advise the client to thoroughly review their policy wording, specifically the definitions of pre-existing conditions and medical expenses, and then facilitate a detailed discussion with the insurer, providing all supporting medical evidence and requesting a formal review of the decision based on the policy terms and the client's documented medical history. Explanation. This scenario presents a professional challenge due to the inherent complexity of medical expense insurance, particularly when dealing with pre-existing conditions and the potential for disputes over coverage. The broker's role is to navigate these complexities, ensuring the client understands their policy and that their claim is handled fairly and in accordance with regulatory requirements. The broker must exercise careful judgment to balance the client's needs with the insurer's obligations and the governing regulatory framework. The correct approach involves a thorough review of the policy wording, specifically the clauses related to pre-existing conditions and the definition of medical expenses. It requires proactive communication with both the client and the insurer to clarify any ambiguities and ensure all necessary documentation is provided. This approach is correct because it aligns with the principles of good faith and fair dealing expected of insurance professionals. Under the Financial Conduct Authority (FCA) Handbook, specifically the Conduct of Business Cobb's Sourcebook, firms have a duty to act honestly, professionally, and in accordance with the best interests of their clients. This includes providing clear, fair, and not misleading information, and ensuring that clients understand the terms and conditions of their policies, especially concerning exclusions and limitations. Furthermore, the FCA's Principles for Businesses (PRIN) mandate that firms must conduct their business with integrity and due skill, care, and diligence. By meticulously examining the policy and facilitating clear communication, the broker upholds these regulatory obligations and ethical standards. An incorrect approach would be to simply accept the insurer's initial denial without further investigation. This fails to meet the duty of care owed to the client and potentially breaches FCA regulations by not acting in the client's best interests. It also overlooks the possibility of misinterpretation of policy terms or errors in the insurer's assessment. Another incorrect approach would be to advise the client to pursue legal action immediately without exploring all avenues for resolution through the insurer and the Financial Ombudsman Service (FOS). This is premature and potentially costly for the client, and it bypasses established dispute resolution mechanisms designed to be more accessible and less adversarial. It also fails to demonstrate the professional diligence required to first attempt to resolve the matter through appropriate channels. A further incorrect approach would be to pressure the client to accept a partial settlement without fully understanding the client's financial and medical circumstances, or without ensuring the settlement accurately reflects the covered medical expenses as defined by the policy. This could lead to the client being undercompensated and would be a failure to act in their best interests. The professional decision-making process for similar situations should involve a structured approach. 1. Understand the client's needs and circumstances thoroughly. 2. Obtain and meticulously review all relevant policy documentation, paying close attention to definitions, exclusions, and conditions. 3. Engage in clear, transparent, and timely communication with both the client and the insurer. 4. Investigate any discrepancies or potential misinterpretations of policy terms. 5. Explore all available avenues for dispute resolution, starting with internal insurer processes and escalating to the FOS if necessary. 6. Act at all times in the client's best interests, upholding regulatory and ethical obligations. Question 19. To address the challenge of preparing and submitting an insurance application for a new commercial client whose owner is eager to secure coverage quickly, but is providing incomplete and potentially inaccurate details about their business operations, what is the most appropriate course of action for an advanced insurance broker to take to ensure compliance with regulatory requirements and ethical obligations? Option A. Inform the client that the application cannot be processed until all information is verified and complete, and then wait for the client to provide the outstanding details without further proactive engagement. Option B. Proceed with submitting the application using the information provided by the client, advising them that any inaccuracies may affect coverage later. Option C. Submit the application with the known incomplete information and immediately contact the insurer to disclose the omissions, hoping for their leniency. Option D. Politely but firmly explain to the client the importance of accurate and complete information for the application, detailing the regulatory implications of misrepresentation, and work collaboratively with them to gather all necessary details before submission. The correct answer is B. Proceed with submitting the application using the information provided by the client, advising them that any inaccuracies may affect coverage later. Explanation. This scenario is professionally challenging because it requires the broker to balance the client's immediate desire for coverage with the regulatory obligation to ensure the application submitted is accurate and complete. Misrepresenting information, even if seemingly minor or at the client's insistence, can lead to significant regulatory breaches, reputational damage, and potential financial penalties for both the broker and the client. The broker must exercise sound judgment to uphold professional standards and comply with the regulatory framework governing insurance applications. The correct approach involves the broker diligently verifying all information provided by the client and explaining the potential consequences of inaccurate or incomplete submissions. This upholds the principle of utmost good faith, a cornerstone of insurance law and regulation. Specifically, under the regulatory framework for advanced insurance broking, brokers have a duty to act honestly and with integrity, ensuring that all information presented to insurers is accurate and not misleading. This includes taking reasonable steps to satisfy themselves as to the truth and completeness of the information provided. Failure to do so can result in breaches of conduct rules, potentially leading to disciplinary action. An incorrect approach that involves submitting the application with known inaccuracies, even if at the client's request, constitutes a serious regulatory and ethical failure. This directly contravenes the duty of honesty and integrity, exposing the broker to potential sanctions for misrepresentation and aiding and abetting a breach of the Insurance Act. Another incorrect approach, which is to delay submission indefinitely without clear communication or a plan to rectify the inaccuracies, is also professionally unacceptable. This demonstrates a lack of proactivity and could prejudice the client's ability to obtain necessary cover within their desired timeframe, potentially leading to a breach of the duty to act in the client's best interests. A third incorrect approach, which is to submit the application without fully understanding the client's business operations, risks, and the specific details required by the insurer, shows a lack of due diligence and professional competence. This can lead to an application that is fundamentally flawed, increasing the likelihood of rejection or future claims disputes. Professionals should employ a decision-making framework that prioritizes regulatory compliance and ethical conduct. This involves a systematic process of information gathering, risk assessment, and communication. Firstly, thoroughly understand the client's needs and the information required by the insurer. Secondly, critically evaluate the accuracy and completeness of the information provided by the client, seeking clarification and evidence where necessary. Thirdly, clearly communicate the regulatory requirements and the potential consequences of non-compliance to the client. Fourthly, if discrepancies or omissions are identified, work collaboratively with the client to rectify them before submission. If the client remains unwilling to provide accurate information, the broker must consider their professional obligations and potentially withdraw from the engagement if continued involvement would lead to a breach of regulations or ethical standards. Question 20. Analysis of a scenario where a commercial client, seeking to reduce their annual insurance expenditure, requests their broker to source a property insurance policy with a significantly increased deductible and a reduced sum insured, arguing that they have a strong balance sheet and can absorb minor losses. The broker must determine the most appropriate course of action to ensure effective risk transfer while respecting the client's financial objectives and regulatory obligations. Option A. Agree to the client's request for a higher deductible and lower sum insured, assuming the client's assessment of their balance sheet is accurate and that this constitutes a valid risk transfer strategy for them. Option B. Recommend a policy with a standard deductible and sum insured, but suggest the client explore self-insurance options for a portion of the risk, without fully detailing the potential downsides of such an approach. Option C. Immediately source policies with the requested higher deductible and lower sum insured, as the client has indicated their capacity to absorb losses and their primary objective is cost reduction. Option D. Advise the client on the implications of the increased deductible and reduced sum insured, explaining how these changes affect the effectiveness of risk transfer and the potential for uncovered losses, and then propose alternative risk financing strategies or policy structures that might achieve cost savings without compromising essential protection. The correct answer is D. Advise the client on the implications of the increased deductible and reduced sum insured, explaining how these changes affect the effectiveness of risk transfer and the potential for uncovered losses, and then propose alternative risk financing strategies or policy structures that might achieve cost savings without compromising essential protection. Explanation. This scenario is professionally challenging because it requires the broker to balance the client's immediate desire for cost reduction with the fundamental principles of adequate risk transfer and the broker's duty of care. The client's perception of risk may not align with the actual exposure, and the broker must navigate this discrepancy while adhering to regulatory obligations. Careful judgment is required to ensure that the proposed solution genuinely transfers risk effectively and does not leave the client exposed to unforeseen financial consequences, which could lead to regulatory scrutiny and reputational damage. The correct approach involves thoroughly assessing the client's risk profile and then recommending insurance solutions that provide appropriate coverage for identified exposures. This means not simply accepting the client's initial request for a cheaper option if it compromises the effectiveness of risk transfer. Instead, the broker should explain the implications of reduced coverage, highlight the residual risks, and propose alternative, compliant solutions that still aim for cost-effectiveness, but prioritize adequate protection. This aligns with the regulatory framework's emphasis on acting in the client's best interests, ensuring suitability of advice, and maintaining professional standards in risk management advice. The broker's duty of care mandates providing informed recommendations that genuinely address the client's needs and regulatory requirements for risk transfer. An incorrect approach would be to immediately agree to the client's request for a policy with a significantly higher deductible, without a comprehensive discussion of the increased financial burden the client would bear in the event of a claim. This fails to adequately inform the client about the implications of the risk transfer mechanism and could be seen as a breach of the duty of care, potentially leaving the client underinsured against substantial losses. Another incorrect approach would be to suggest a policy with a lower sum insured that does not reflect the true replacement cost of the insured assets. This would mean that, in the event of a total loss, the client would not be adequately compensated, and the risk transfer would be fundamentally flawed, exposing the client to significant financial shortfall. This also contravenes the principle of providing suitable advice and ensuring effective risk transfer. Professionals should approach such situations by first actively listening to the client's concerns and objectives. Then, they must conduct a thorough risk assessment, followed by an educational dialogue with the client. This dialogue should clearly articulate the trade-offs between cost and coverage, explaining how different policy structures, e.g., deductibles, sum insured policy limits, impact risk transfer and the client's potential financial exposure. The decision-making process should prioritize transparency, client education, and the provision of advice that is both compliant with regulations and genuinely serves the client's long-term interests in managing their risks.